Takes us to our talk of the tape, whether investor sentiment has just gotten too bullish. Let's ask Josh Brown. He's Ritholtz Wealth Management CEO and a CNBC contributor. He is with me here at Post 9. It's good to see you. Welcome back. You think that's the case? We got all bulled up because of the way we ended 23. We came in here and thought, hey, this could be smooth sailing, and maybe not so much.
Let me answer your question with a question.
Yeah.
Do you think the market goes up because people get bulled up? Or do people get bulled up because the market went up?
The latter.
Okay, I agree with you. Why wouldn't investors be bulled up? Did you see the way that market ended last year?
Sure.
It literally ended like the 4th of July. It was picnics and watermelon and then fireworks. And I don't know if you were an investor, what more you could have wanted to see. The VIX was just vol smashed almost to zero, and everything went up. Of course, people got bulled up. And that's quite all right. They should. I'd actually think there'd be something wrong if we had an S&P 500 finish the year up 25%, NASDAQ up 50%, and nobody was bullish. That would be problematic.
Yeah, but it's one thing to get all bulled up on July 4th. It's another thing to be all bulled up in March because you're waiting for the fireworks that may not go off yet because they're not supposed to go off yet. It's kind of what Jamie Dimon was talking about today out in Davos. I want you to listen to what he said about this idea.
I always listen to Jamie.
Market goes up and everybody gets bullish. Well, maybe that's a little too much. Listen.
I think it's a mistake to assume that everything's hunky-dory. And, and when stock markets are up, it's kind of like this little drug we all feel. Like, it's just great, But remember, we've had so much fiscal and monetary stimulation. So I'm a little more on the cautious side that we are facing a lot of things in 24 or 25.
I mean, maybe we're coming to grips with what we're facing. Maybe rates aren't going to be straight down. Inflation's not going to be straight down. Growth is going to be a little lumpy.
So I actually prefer my risk manager to speak the way that he does. Mm-hmm. I would be terrified if he were on the air saying, guns blazing. Let's have another breakout year like we had last year. That's not what he's supposed to be doing. Okay, this is the head of the largest deposit institution in the United States. It's a bulletproof bank. It should be a bulletproof bank, and the reason it is because Jamie Dimon is a risk manager first and foremost. That's his job. I'm glad that he's speaking that way. I hope most people are. That being said, what we're experiencing right now is exactly what you should expect after a rally as blisteringly hot as the one that we just had. So I want to walk you through a couple of things that we're looking at, and this is what we're talking to clients about. Okay. The first is the correlation between the VIX and the 10-year is at its highest level since 2018, back when the scariest thing in our lives was the trade war. Remember the trade war? That was fun. Okay. Anyway, the low point for this correlation was actually March of 2020 when it became apparent rates were going really low and not moving for a long time. Now we're back at a high of almost a 6-year high in that correlation. All that's telling us is that markets are getting a little bit shakier, but for the right reason. If you're seeing that 10-year note yield climb, it tells you that we are further away from the Fed looking to take policy down, and stocks don't love that, and that's perfectly fine. If we were selling off for any other reason, I would be singing a different tune, but that's really all that's changed. Nothing else has changed. We're back in an earnings season. So far, so good. The banks all had great things to say. We've got a lot further to go, but we are not experiencing a sell-off based on a risk to corporate profits. So it could happen. It's just not the story right now.
What about the idea that we may be too bulled up on sentiment? We may be too bulled up on...
That's curing itself. It's curing itself.
The idea of all these interest rate cuts, and maybe most of all, that we're looking past a valuation that is stretched well beyond the historical average for all three of the majors, and that's what Aswath Damodaran yesterday, the so-called dean of valuation, said the S&P's value overvalued in his mind by 9 to 10%.
But that has nothing to do with what's going on this year, and here's my proof. The worst performing sector, small caps, are the lowest valuation. So that is not what the issue is. Small caps are now down 6% on the year. They finished the fourth quarter with a 14% rally. Almost all of it happened in the last 6 weeks of the year. It's a little bit of a give back.